Wyckoff's genius lay in his ability to distill complex market dynamics into a set of fundamental principles, presenting them not as abstract theories but as practical tools for everyday trading decisions. He emphasized that true market insight comes from understanding the underlying cause and effect relationships that govern price action, rather than relying on fleeting indicators or emotional reactions. His framework empowers traders to look beyond superficial price movements and to grasp the true intentions of the market's dominant players. By mastering these foundational concepts, individuals can unlock a deeper level of market comprehension, moving closer to the goal of consistently profitable trading. This approach transcends mere pattern recognition, delving into the very psychology and mechanics that shape market cycles. At the core of Richard Wyckoff's analytical framework stand three fundamental laws, each providing a unique lens through which to view and interpret market behavior. These laws are not independent entities, but rather interconnected pillars, forming a robust foundation for understanding the market's inherent logic and predicting its future direction. Their power lies in their synergy, offering a holistic perspective that is far greater than the sum of its individual parts. Wyckoff taught that by diligently applying these principles, traders could effectively read the market, deciphering the intentions of large institutional players and positioning themselves accordingly. This integrated approach is what differentiates his method, elevating it beyond simple technical indicators to a comprehensive market philosophy. The first of these foundational pillars is the law of supply and demand, a timeless economic principle that Wyckoff adapted for precise market analysis. This law states that when demand for an asset exceeds its supply, prices will naturally rise as buyers compete for limited availability. Conversely, when supply overwhelms demand, prices will fall as sellers vie to offload their holdings. Wyckoff understood that this fundamental balance is the ultimate determinant of price movement, dictating whether an asset will trend upwards, downwards, or remain within a trading range. He meticulously studied how this balance shifted, looking for subtle clues in the price and volume data. Richard Wyckoff applied the law of supply and demand by closely examining the interplay between price action and trading volume. He viewed volume as the effort and price movement as the result, using their relationship to gauge the true strength behind market moves. For instance, a strong upward price movement accompanied by high volume indicated robust demand, confirming the upward trend. Conversely, a price rally on low volume suggested weak demand, potentially foreshadowing a reversal or a period of consolidation. Wyckoff taught his students to scrutinize these relationships, understanding that large professional operators leave clear volumetric footprints. The predictive role of the law of supply and demand is paramount in Wyckoff's methodology, serving as the primary compass for determining the market's direction. By consistently analyzing the balance between buying and selling pressure, traders can identify periods where one force is clearly dominating the other. This allows them to anticipate the most probable path of least resistance for prices. For example, sustained periods of accumulation, characterized by absorption of supply by strong hands, signal an impending uptrend. Conversely, distribution phases, where smart money offloads assets, warn of an impending decline. This direct correlation makes it an indispensable tool for anticipating major shifts. The second cornerstone of Wyckoff's analytical structure is the law of cause and effect, a principle that underscores the preparatory nature of significant market movements. This law posits that every substantial price trend, the effect, must be preceded by a period of preparation or consolidation, the cause. It highlights the idea that markets do not move spontaneously, but rather build energy and conviction over time within specific trading ranges. Wyckoff believed that the magnitude of the cause directly dictates the potential magnitude of the effect, providing a quantifiable basis for projecting future price targets. This concept moves beyond mere trend identification, offering insights into the potential scope of those trends. Wyckoff developed a sophisticated method for measuring the cause during these periods of consolidation, primarily through the use of horizontal point and figure chart counting. Within an accumulation or distribution trading range, the horizontal count of the price action on a point and figure chart provides a quantifiable measure of the energy being built up. Each column on the point and figure chart represents a certain amount of price movement and time spent within the range, accumulating points that directly correlate to the potential future movement. This meticulous counting allowed him to estimate the potential distance a price could travel once it broke out of its consolidation phase. The predictive power of the law of cause and effect lies in its ability to determine the potential duration and scale of an impending trend. A longer period of accumulation or distribution, represented by a greater horizontal count on a point and figure chart, signifies a larger cause and consequently a more substantial effect. This means that a protracted period of sideways trading, where supply and demand are battling for dominance, is likely to precede a more extended and significant price trend. Traders can use this law to set realistic price targets and to gauge the potential reward of a trade, understanding that the market's preparation directly influences its subsequent journey. The third fundamental principle in Richard Wyckoff's trading philosophy is the law of effort versus result, which provides a critical lens for evaluating the health and sustainability of a market trend. This law focuses on the relationship between the volume of trading, the effort expended by market participants, and the corresponding price movement, the result of that effort. It seeks to identify harmony or divergence between these two elements, offering early warnings of potential trend changes or confirmations of trend strength. Wyckoff understood that genuine market conviction is always reflected in a consistent alignment of effort and result. When effort and result are in harmony, it signals a healthy and likely continuation of the current trend. For instance, if prices are rising significantly on increasing volume, this indicates that substantial buying effort is yielding a strong upward result, confirming the presence of genuine demand. Similarly, if prices are falling sharply on high volume, it suggests that significant selling pressure is producing a clear downward result, validating the downtrend. This consistent relationship provides confidence that the dominant market force remains in control, pushing prices in its intended direction. Traders look for this harmony to confirm their bias. Conversely, divergences between effort and result serve as powerful early warnings of potential trend reversals or underlying weakness. A classic example is when prices rise to new highs but on diminishing volume. This suggests that the buying effort is decreasing, yet the price is still moving up, indicating that the result, price increase, is not being supported by adequate effort, volume. Such a divergence signals that the trend might be losing momentum and could be vulnerable to a reversal. Similarly, if prices fail to make significant progress despite high volume, it suggests that strong selling pressure is meeting the buying effort, indicating a struggle and potential distribution. These divergences, such as a high-volume day with little price movement, often indicate that the market is either absorbing significant supply or meeting strong demand, depending on the context. If an uptrend encounters high volume with minimal upward price progress, it often means sellers are actively entering the market, absorbing the buying pressure. This suggests that the smart money might be distributing their holdings, foreshadowing a potential downtrend. The law of effort versus result thus acts as an invaluable diagnostic tool, helping traders to peer beneath the surface and discern the true underlying strength or weakness of price action. Many people search for a single magical trading law that can predict 80% of market moves, believing such a secret holds the key to effortless wealth. However, Richard Wyckoff's true secret is not a solitary rule, but rather a profound understanding of the market's underlying psychological and operational mechanics, embodied by his concept of the Composite Man. This imaginary unified operator represents the collective actions of large institutional traders, professional money managers, and other well-capitalized entities that, together, exert significant control over price movements. Wyckoff believed that by thinking like this Composite Man, traders could anticipate the market's next significant move. The Composite Man, in Wyckoff's view, is a master strategist who carefully plans and executes his trades, meticulously accumulating assets in preparation for an uptrend and distributing them before a downturn. He operates with patience, skill, and a deep understanding of market psychology, often manipulating prices to induce retail traders into making emotional decisions. By envisioning the market as being controlled by this single powerful entity, Wyckoff provided a framework for decoding the intentions of these large players. This perspective helps traders understand that market movements are not random, but rather the result of deliberate actions by informed participants. The three fundamental laws of Wyckoff, supply and demand, cause and effect, and effort versus result, are precisely the tools that help traders decode the Composite Man's intentions. During phases of accumulation, the Composite Man is actively buying, often at lower prices, absorbing supply from weaker hands. This process is characterized by specific price and volume patterns that can be identified through Wyckoff's laws. For example, high volume on down moves that fail to produce significant new lows suggest strong demand is entering the market, a sign of the Composite Man at work. Understanding these patterns allows traders to recognize the footprints left by smart money. Similarly, during phases of distribution, the Composite Man is systematically selling his holdings, often at higher prices, to unsuspecting retail buyers. This process also leaves distinct patterns in price and volume. For instance, a rally on decreasing volume, followed by a sharp drop on high volume, might signal that the Composite Man is actively offloading shares. By applying the law of effort versus result, traders can spot these divergences, understanding that the large operators are exiting their positions. The ability to recognize these signs is crucial for avoiding market traps and aligning with the direction of the powerful players. The significance of understanding the Composite Man for forecasting market movements cannot be overstated. By synchronizing one's trading decisions with the actions of these large, informed participants, traders can significantly enhance their probability of success. Wyckoff taught that the market moves in predictable cycles, driven by the Composite Man's strategic accumulation and distribution. Identifying these phases early allows traders to enter positions when the smart money is buying and exit when they are selling, avoiding costly reversals. This strategic alignment transforms speculation into a more disciplined and calculated endeavor. Wyckoff's methodology provides a practical, step-by-step approach to applying these fundamental laws for making highly accurate market forecasts. One of the most critical aspects of this practical application is the identification of the four distinct phases of the market cycle, as defined by Wyckoff. These phases, accumulation, markup, distribution, and markdown, represent the natural progression of prices as they are influenced by the Composite Man's actions. Recognizing which phase the market is currently in is crucial for making informed trading decisions and for aligning with the prevailing trend. Each phase has unique characteristics that Wyckoff meticulously documented. The accumulation phase marks the end of a downtrend and the beginning of a new uptrend, where the smart money, or Composite Man, actively buys assets from less informed sellers. This phase is typically characterized by a period of sideways price action within a trading range, often accompanied by decreasing volatility and increasing volume on declines that fail to make new lows. Key events within accumulation include the selling climax, automatic rally, secondary tests, and springs, all signaling the absorption of supply. Identifying accumulation early allows traders to position themselves before the significant price advance begins. Following accumulation is the markup phase, which is characterized by a sustained upward trend in prices. During this phase, demand clearly exceeds supply, and the Composite Man is actively pushing prices higher to profit from their accumulated positions. The markup phase is marked by higher highs and higher lows, often accompanied by strong volume on upward movements and relatively lower volume on minor pullbacks. Traders aim to enter positions during accumulation and ride the markup phase, taking advantage of the sustained upward momentum. This is where the profits from earlier accumulation are realized. The distribution phase signals the end of an uptrend and the impending start of a new downtrend. Here, the Composite Man systematically sells off their accumulated assets to the public, who are often drawn in by the preceding price strength. Like accumulation, Distribution is a period of sideways price action within a trading range, but with inverse characteristics. It often features buying climaxes, automatic reactions, secondary tests of supply, and upthrusts, all indicating that supply is overwhelming demand. Recognizing distribution is vital for exiting long positions and preparing for a potential short opportunity. Finally, the markdown phase follows distribution, characterized by a sustained downward trend in prices. During this phase, supply significantly exceeds demand, and the Composite Man benefits from short positions or avoids losses from long positions. The markdown phase is defined by lower lows and lower highs, typically accompanied by strong volume on downward movements. Traders who identify distribution can either avoid losses by selling their long positions or profit by entering short positions, capitalizing on the declining prices. These four phases provide a comprehensive roadmap for market cycles. Another powerful application of Wyckoff's laws involves the meticulous analysis of trading ranges to determine both the cause and to project the effect. As discussed, trading ranges are periods of consolidation where supply and demand are relatively balanced, building up energy for the next significant price move. Wyckoff taught traders to analyze the volume and price action within these ranges to identify whether accumulation or distribution is taking place. This involves observing where the professional money is active, whether buying on weakness or selling into strength, and how the range develops over time. Once the nature of the trading range, accumulation or distribution, is identified, Wyckoff's horizontal point and figure counting method comes into play. By counting the number of columns in the trading range on a point and figure chart, traders can quantify the cause that has been built. This count, when multiplied by a specific factor related to the chart's box size and reversal amount, provides a projection for the effect, the potential price target after the breakout from the range. This systematic approach offers a data-driven way to establish profit targets, moving beyond arbitrary estimations. For example, if an accumulation range has a horizontal count that projects a significant upward move, traders can confidently target those higher prices once the market breaks out of the range. Conversely, a distribution range with a large horizontal count suggests a substantial downward movement is likely. This method provides a clear, objective way to forecast the potential magnitude of future price trends, making it an indispensable tool for strategic planning and risk management. It transforms the often subjective process of target setting into a more precise science. The meticulous analysis of volume and price action, often referred to as volume-price analysis, is central to applying Wyckoff's law of effort versus result for highly accurate forecasts. Wyckoff viewed volume not merely as an indicator but as the raw effort of the market, which must be constantly compared against the result in price movement. This continuous comparison allows traders to gauge the conviction behind price moves and to identify potential turning points before they become obvious to the broader market. It is a dynamic, real-time assessment of market strength and weakness. Using volume as a key indicator of effort, traders can confirm the strength of a trend. A strong uptrend should ideally be accompanied by high volume on price advances and lower volume on corrections. This pattern suggests that buyers are eager to participate while sellers are reluctant to sell into the strength. Any deviation from this pattern, such as an uptrend losing momentum despite high volume, immediately raises a red flag. This divergence signals that the buying pressure might be encountering significant selling, potentially indicating distribution. Conversely, a downtrend should show high volume on price declines and lower volume on rallies. This indicates strong selling pressure and a lack of buying interest. If a downtrend starts to show high volume on upward rallies, but fails to make significant price progress, it could signal that professional money is beginning to accumulate, absorbing the selling pressure. Wyckoff's volume-price analysis provides a nuanced understanding of these dynamics, allowing traders to anticipate shifts in the supply-demand balance and, consequently, in the market's direction. It is a powerful method for early trend reversal detection, For those serious about mastering these profound market insights, deeper study is often required beyond introductory explanations. Richard Wyckoff's own seminal work, How I Trade and Invest in Stocks and Bonds, offers an unparalleled opportunity to immerse oneself in the original teachings of this market legend. This isn't just another trading book. It is an adapted edition of Wyckoff's classic, meticulously presenting his time-tested methods for analyzing market action, discerning the true intentions of major market players, and making highly informed trading decisions. It provides a direct pathway to understanding the foundational principles discussed, straight from the master himself. Imagine having the wisdom of Wyckoff at your fingertips, guiding you through the complexities of market structure and behavioral patterns. This book is a comprehensive guide, filled with practical examples and detailed explanations that illuminate the intricate dance of supply and demand, cause and effect, and effort versus result. It empowers you to develop a systematic approach to trading, moving beyond guesswork to a confident, logical framework. By studying Wyckoff's original insights, you gain a unique advantage, learning to read the market's hidden language and anticipate its moves with greater precision. Don't miss the chance to learn from one of the greatest market analysts in history. Secure your copy of How I Trade and Invest in Stocks and Bonds today, and begin your journey to becoming a more proficient and profitable trader. The link is available in the description below. The claim that Wyckoff's method can predict 80% of market moves is not attributed to a single isolated law, but rather to the comprehensive and integrated approach it offers. This high degree of accuracy stems from the synergistic application of his three fundamental laws and the understanding of the Composite Man. It is the combination of these powerful analytical tools that allows traders to gain a significant edge, moving beyond speculative guesswork to a systematic and logical understanding of market behavior. The method's strength lies in its ability to provide a holistic view of the market, integrating multiple layers of analysis. Wyckoff's methodology provides a systematic understanding of market logic and the psychology of its participants. By constantly analyzing supply and demand, cause and effect, and effort versus result, traders can read the market's narrative as it unfolds. This deep insight allows them to anticipate the intentions of large institutional players, understanding when they are accumulating or distributing assets. It's not about predicting every single wiggle, but identifying high-probability turning points and sustained trends, aligning with the powerful forces that move prices. This systematic approach removes much of the emotional bias from trading. Another reason for the method's high accuracy is its remarkable adaptability across various financial markets and timeframes. Whether trading stocks, foreign exchange, commodities, or cryptocurrencies, and whether operating on daily, weekly, or intraday charts, Wyckoff's principles remain universally applicable. The underlying dynamics of supply and demand, and the actions of large operators, are consistent across different asset classes and time horizons. This universality makes it an incredibly versatile and enduring tool for market analysis, transcending specific market conditions or asset characteristics. Furthermore, the Wyckoff method places a strong emphasis on identifying high-probability trading opportunities. It teaches traders to wait for clear signals of accumulation or distribution, combined with confirmation from volume and price action, before entering a trade. This patient and disciplined approach minimizes impulsive decisions and focuses on setups where the odds are clearly in the trader's favor. By focusing on these optimal entry and exit points, the method naturally leads to a higher success rate, as trades are initiated based on robust evidence rather than mere speculation. Crucially, the Wyckoff method inherently incorporates principles of risk management by identifying key support and resistance levels within trading ranges. Understanding where accumulation or distribution is occurring helps traders set logical stop-loss orders and profit targets. By defining the potential cause and projecting the effect, traders can assess the risk-reward ratio of a trade before entry, ensuring that potential losses are limited while potential gains are substantial. This integration of risk management is fundamental to long-term trading success, making the method not just about prediction, but also about sustainable profitability. In conclusion, the mastery of Richard Wyckoff's three fundamental laws, the law of supply and demand, the law of cause and effect, and the law of effort versus result, combined with a deep understanding of the Composite Man, is truly the key to unlocking the market's hidden movements. These principles are not isolated concepts, but rather highly interconnected elements that form a powerful, integrated framework for market analysis. They provide a systematic lens through which to decode the complex interplay of forces that drive price action, transforming what often appears to be a chaotic environment into a more predictable landscape. Wyckoff's methodology empowers traders to move beyond simplistic indicators and emotional reactions, enabling them to read the market's underlying logic and anticipate the intentions of large institutional players. By diligently applying these time-tested principles, individuals can identify high-probability trading opportunities, synchronize their actions with the smart money, and avoid common market traps. This profound understanding allows for more informed decision-making, significantly enhancing the potential for consistent and profitable trading outcomes across various financial markets and timeframes. The journey to becoming a proficient Wyckoff trader requires dedication, practice, and a commitment to continuous learning. It is an investment in developing a skill set that offers a distinct advantage in the competitive world of financial markets. Embracing Wyckoff's teachings means adopting a disciplined, analytical approach that focuses on understanding the fundamental causes behind price movements. This mastery allows traders to navigate the market with confidence, turning its inherent volatility into opportunities for strategic gain. And to further deepen your understanding of the intricate world of market analysis and trading, consider exploring some invaluable resources. Our channel, Trading Insights, offers a wealth of strategies, methods, and principles employed by successful traders, speculators, and investors, providing practical applications and real-world examples to sharpen your analytical edge. It delves into the nuances of market psychology and technical frameworks, much like Wyckoff's own approach, but through the lens of modern market dynamics. Furthermore, for those fascinated by the historical tapestry of finance and the legendary figures who shaped it, Wall Street Memoirs is an essential destination. This channel brings to life historical events, financial crises, and the lives of outstanding individuals from Wall Street, offering crucial context that illuminates today's market behavior. Understanding the past, as Wyckoff himself did, provides invaluable lessons for navigating the future. Both channels are designed to complement your learning journey, offering diverse perspectives and deep dives into the multifaceted world of finance. Don't miss out on these opportunities to expand your knowledge and refine your market understanding. Subscribe to Trading Insights and Wall Street Memoirs today to continue building your expertise. You can find links to both channels in the description below.